You know, most of us have this sort of romantic mental image of how American capitalism is supposed to work.
Right, the classic picture.
Yeah, exactly. The classic picture where you have millions of independent investors buying stocks, thousands of companies fiercely competing for capital, and this chaotic but beautiful invisible hand just guiding everything toward the best possible outcome.
The ultimate democracy of money.
Exactly. The ultimate democracy of money.
Well, I mean, that is the textbook definition, yeah. It's the story we like to tell ourselves about free markets.
But what if I told you that the invisible hand has actually been, well, replaced?
Oh, replaced is a strong word, but accurate.
Right. What if, instead of millions of independent decision makers, the fate of the entire American economy, like who sits on the board of Apple, or whether Exxon pivots to green energy, or even how much CEOs get paid,
Huh.
what if all of that is effectively decided by about 12 people sitting in a conference room?
Haha. It really does sound like the opening scene of a conspiracy thriller, doesn't it?
It totally does.
But the thing is, what you're describing isn't fiction. And it definitely isn't a conspiracy theory.
No.
It is the central premise of the book we are covering today for our deep dive, which is The Problem of 12 by John Coates.
And Coates is not some fringe internet guy.
Not at all. He's a heavyweight in the legal and economic world. He analyzes the exact intersection of law and economics, so he knows exactly how these systems are wired.
Right. And the scariest, or I guess maybe the most fascinating part, is that these 12 people aren't some Illuminati figures in hooded robes.
No, they wear Patagonia vests.
Uh-huh, exactly. They're investment managers. They run the institutions that hold our money, you know, our 401k accounts, our retirement funds.
The money of everyday people.
Yeah. And today, we're going to unpack exactly how we got here and why Coates thinks this massive concentration of power is a fundamental threat to the way our system operates.
Because this isn't just about stocks going up or down. That's the key takeaway right up front.
Right, it's bigger than that.
Much bigger. Coates argues that we are facing a recurring historical phenomenon. He calls it the problem of 12.
Which means?
It's this idea that financial systems, in left entirely to their own devices, inevitably drift toward concentration. A very small number of actors eventually acquire the means to exert just this outsized influence over a nation's politics and its economy.
I mean, we've seen this movie before, haven't we? Like the robber barons?
The robber barons, absolutely, or the central bankers of the early 20th century.
Right.
But Coates points out that we are facing a totally new version of this problem today, and it's driven by two very specific financial giants.
Index funds and private equity funds.
Exactly. Index funds and private equity. And really, the mission of this deep dive today is to understand the tension here.
The tension between two competing ideas, right?
Yes. On one side, you have economies of scale, getting big to save money and be hyper-efficient.
Which is usually a good thing for consumers.
It usually is. But on the other side, you have democratic values. And those values rely on fragmenting power to prevent tyranny.
So we aren't just talking about investment returns here. We are talking about who actually owns corporate America.
Who owns it and who bosses it around.
Okay, to understand the new problem, though, we really have to look at the old one.
Yeah.
So let's take us back to the old world of the 20th century. Before these index funds took over, who was running the show?
Okay, so for most of the 20th century, the economy was dominated by what we call public companies.
Like the classic titans.
Right. Think of AT&T, IBM, General Motors, the absolute behemoths.
Yeah.
And the prevailing theory of how these companies actually worked came from a landmark analysis done way back in 1932.
1932, okay.
By two guys named Adolf Berle and Gardner Means.
Berle and Means. I mean, that sounds like a law firm you'd hire to write a very boring will.
Aha, it does. But their discovery was revolutionary. They identified what they called the separation of ownership and control.
Okay, break that down for us. What does that actually mean in practice?
Here is the logic. If you have a massive company like AT&T in 1930, the ownership of that company is sliced up into millions of tiny shares.
Right, and those are held by thousands of different regular people.
Exactly. You might own 10 shares, I might own 20 shares.
And because I only own 10 shares, I'm not going to fly all the way to the headquarters to yell at the CEO over some minor policy change. It's not worth the plane ticket.
Exactly. It's what economists call a classic collective action problem.
Because we are so dispersed.
Right, because the owners are so scattered, they can't possibly coordinate to tell the CEO what to do. So Berle and Means had this aha moment.
Which was?
They realized that the owners, the actual shareholders, didn't have the real power.
Oh, wow.
The managers did. The CEOs and the board of directors held the real power, even though they didn't technically own the company.
So the inmates were running the asylum, or I guess the employees were running the company because the owners were just too scattered to stop them.
That's a very fair way to put it. This era was known as managerialism.
Managerialism.
But then, of course, came the Great Depression. The 1929 crash absolutely destroyed the public's faith in these corporate managers.
Because everyone lost their shirts?
Everyone lost everything. There was rampant fraud, there was insider dealing, and people just fundamentally felt the game was rigged by these managers.
Enter Franklin Delano Roosevelt and the New Deal.
Yes. And FDR's solution to this massive trust issue was sunlight.
Sunlight meaning disclosure.
Exactly. In 1934, the government created the SEC, the Securities and Exchange Commission.
Right.
And the idea was actually pretty simple. The government said, look, we aren't going to tell you how to run your business. But if you want to sell stock to the public, you have to tell the truth.
You have to open your books.
You have to open your books, exactly.
Now, I found this detail from the source material absolutely hilarious. Apparently, the corporate managers back then absolutely hated this.
Oh, despised it.
They called the SEC Russian.
Yes. Russian, meaning communist.
Oh, that's so funny. Just basic accounting disclosure, and they're like, this is a communist plot.
They honestly thought the government forcing them to disclose their finances was the literal end of free enterprise.
But it kind of did the opposite, didn't it?
Ironically, it saved capitalism. That transparency completely restored public trust.
Right.
It made U.S. capital markets the deepest and most liquid in the entire world.
Because investors actually knew they weren't being totally scammed.
Precisely. They could read the actual financial statements.
So that was the status quo for decades. You had these powerful CEOs, but they were kept in check somewhat by the SEC and disclosure, and they were funded by this huge fragmented ocean of small investors.
That was the Berlin means world.
But then, in the 1960s and 70s, the script totally flips. We get what the outline calls the rise of the machine.
The rise of the machine. And this actually starts in the ivory tower with academics.
Like economists.
Yeah, heavyweights like Paul Samuelson, Burton Malkiel, and Eugene Fama.
Okay.
They started proposing something that sounded incredibly radical at the time. The efficient market hypothesis.
Which is really just a fancy academic way of saying you can't beat the market.
Essentially, yes. They argued that stock prices reflect all available information instantly.
Instantly. So there's no secret edge.
Right. So trying to pick winning stocks is a fool's errand. Malkiel called it a random walk.
So you might as well just throw darts at a dartboard as pay some fancy Wall Street expert to pick stocks for you.
That was exactly the analogy they used.
So the logic becomes if you can't beat them, join them. Just buy everything.
Buy everything. Buy a basket of all the stocks. Create an index.
And this leads us to Jack Bogle.
Yes. Jack Bogle founds Vanguard in 1974. And then in 1976, he launches the very first index mutual fund available to the general public.
And Wall Street just loved him for it. I gave him a ticker tape parade.
Oh, quite the opposite. They mocked him relentlessly.
Really?
They called it Bogle's folly.
Bogle's folly.
You have to understand the culture of Wall Street. It is built entirely on the idea of winning, of being smarter than the next guy.
Right, the master of the universe complex.
Exactly. And here comes Bogle saying, you aren't smarter, you're just more expensive.
Wow. That hits him right in the ego and the wallet.
It did. To them, it seemed almost un-American to not even try to win, to just settle for average.
But Bogle had the last laugh.
He certainly did. In fact, Paul Samuelson later ranked the invention of the index fund alongside the wheel and the printing press.
Okay, the wheel and the printing press. That is incredibly high praise for a financial product.
As one of the greatest innovations in human history, yeah.
Why did it win so hard? Why did it take over?
Really, it comes down to two reasons: cost and simplicity.
Let's talk about cost first.
The source notes that expense ratios for index funds are absolutely tiny. We are talking around 0.06%.
Around 0.6.
Compared to active funds, which are often 15 times more expensive than that.
15 times. And over 30 years of compounding, that fee difference isn't just a rounding error.
It is life-changing wealth for a normal retiree.
Yeah. And the second reason was simplicity.
Right. For the average learner, the everyday person, it requires zero time. You don't have to research stocks. You don't have to read balance sheets.
You just buy the whole market and go play outside.
Exactly. And then technology just poured gas on the fire.
Oh, totally. Spreadsheets, the internet.
Automatic 401k enrollments.
Right. You get a new job. and you're just defaulted into a target date index fund. It just became the default setting for money
And that default setting brings us squarely to the new problem of 12.
because of the economies of scale.
Yes. Because getting bigger doesn't make it harder to manage an index fund. It actually makes it vastly more profitable, so the entire industry consolidated.
Everyone just moved their money to the cheapest, biggest providers,
Exactly. And we are talking about the big four here.
which are Vanguard, BlackRock, State Street, and Fidelity.
Correct. Now, Fidelity was traditionally an active stock-picking shop, but they've moved heavily into indexing now, too, just to compete.
And the concentration here is just staggering.
It is. These firms now control more than 20% of the votes in the S&P 500.
See, 20% might not sound like a majority to someone listening. Like, it's not 51%.
Right. But in corporate elections, where voter turnout is often low and ownership is otherwise totally fragmented, 20% is absolute kingmaker territory.
So they decide who wins.
Without a doubt, it is a higher concentration of ownership than any 3 single investors have ever held in the entire history of the United States.
Wait, really? Not even the robber barons?
Even the robber barons didn't have this specific kind of broad, sweeping grip across the entire economy. They controlled specific industries, like oil or railroads.
But the big four own a huge chunk of everything.
Everything. And the trend line is steep. If growth continued at recent rates, though, the author notes it will likely find an equilibrium before this actually happens. They could theoretically own the entire U.S. market by the mid-2030s.
The entire market.
Yes.
So we have completely moved away from that Burl and Means world we talked about earlier,
Yeah.
where the owners were scattered and weak,
Right.
to a world where a dozen people at these massive fund complexes hold the voting power for most of corporate America.
That is the core shift. The absentee landlord of the 20th century has been replaced by the titan of 12.
But wait, here is the paradox I really struggle with when reading this.
Okay.
These are passive funds.
Yes.
By definition, they aren't supposed to do anything. They just buy the list of stocks in the index.
Right.
So how can they be so powerful if they're basically just running a computer program that automatically buys stocks?
That is the single biggest misconception out there.
Really?
Yes. They are passive in how they pick stocks, meaning Vanguard can't just sell a company's stock because they don't like the CEO's new strategy.
Because they have to mirror the index?
Exactly. But they are not passive in how they vote those shares. They exploit the gap between control and influence.
Because they can't sell, they have to vote.
Exactly. In economics, you usually have 2 options when you are unhappy with an investment: exit or voice.
Exit or voice. Okay.
If you don't like a company, you exit. You sell the stock.
Right, you take your money elsewhere.
But index funds cannot exit. They are locked in permanently as long as the company is in the index.
So their only option is voice.
Yes. Using their massive voting blocks to force the company to change.
Okay, the source material gives a perfect example of this in action, and it is such a David and Goliath story.
The ExxonMobil Showdown.
Yes. Talk about this because this blew my mind.
It is really the defining case study for this new era. So you had engine number 1, which was a tiny hedge fund.
Tiny.
They owned just 0.02% of ExxonMobil.
0.02%. A microscopic stake.
Basically nothing in the grand scheme.
Exxon is an absolute giant.
Over $300 billion in assets.
Exxon probably spends more on printer ink than engine number 1 was even worth.
Haha, probably. But engine number 1 decided to challenge Exxon's board of directors anyway.
On what grounds?
Their argument wasn't just about short-term profits, it was about long-term strategy. They argued Exxon wasn't managing the transition risks of moving to a green economy well enough.
So they felt Exxon was ignoring climate change at its own financial peril.
Exactly. So engine number 1 proposed replacing 4 of Exxon's board directors with new people who actually understood energy transition.
Usually, a massive company like Exxon would just swat a tiny hedge fund like this away like a fly.
Usually, yes. They wouldn't even sweat it. But engine number 1 actually won.
Like one.
They got 3 seats on the board of ExxonMobil.
How does a firm with 0.02% of the stock win 3 board seats at a $300 billion oil company?
Because the big 3, BlackRock, Vanguard, and State Street, voted with them.
Wow.
Even Vanguard, which is traditionally the quietest and most conservative of the entire group, voted for the activist nominees.
That is wild. So this tiny little hedge fund started the fight, but the giant index funds finished it.
Exactly, they were the muscle. And it really showed that Larry Fink, the CEO of BlackRock, wasn't just using cheap talk when he wrote about climate risk in his famous annual letters to CEOs.
He actually backed it up with votes.
This vote proved that these passive funds are the ultimate arbiters now. If they decide a corporate board needs to change, it changes. Period.
So what does this all mean for the CEO of a regular publicly traded company? It seems like they basically have a new boss.
They do. And the influence goes way beyond just the annual voting meeting once a year.
Right.
We need to talk about what the industry calls engagements.
Engagement. Sounds like a very polite, diplomatic term.
Right.
Or like a wedding announcement.
It is very diplomatic. These are private meetings or phone calls between the index fund managers and the CEOs of the companies they own.
Behind closed doors.
Yes. BlackRock actually reported having over 2,000 of these engagements in a single year.
2,000. That's nearly 6 meetings a day, every single day of the year, including weekends.
It means they're constantly talking to management, constantly nudging them. And this whole dynamic creates what Coates calls the Goldilocks dilemma for the index funds.
The Goldilocks dilemma. Explain that.
Basically, they are criticized heavily from both sides of the political and economic spectrum.
Okay.
One side looks at them and says, you have way too much power. You're the problem of 12. You're distorting the free market.
And the other side?
The other side says, you're too passive. You own 20% of the company. Why aren't you doing more to steward shareholder wealth? Why aren't you fixing these broken companies?
So they are damned if they do and damned if they don't.
Exactly. And there is a massive network effect here, too. It's not just the big four acting totally in isolation.
Right. They aren't operating in a vacuum.
No, there's this whole governance machine. It includes proxy advisors like ISS, state pension funds, other activists.
Yeah. How do they interact?
Well, when a big index fund sets a sweeping policy, say they announce, we want to see more gender diversity on boards, or we need better disclosure on carbon emissions.
The rest of the market pays attention.
The whole market moves because nobody wants to fight them.
It's the implication. CEOs know that if a hedge fund attacks them, the index funds will be the deciding vote.
Yes.
So the CEOs just keep the index funds happy to prevent the attack from happening in the first place.
Precisely. It keeps managers completely in line without the funds ever having to issue a direct formal order. It essentially homogenizes corporate strategy across the entire public economy.
Okay, so that's the index fund side of the problem of 12. Highly concentrated, very transparent, and very powerful in the daylight.
Right.
But there is a shadow side to this story that Coates warns about in the book. A much darker side.
The shadow market. Private equity.
This feels like the evil twin. While index funds are all about buy everything and disclose everything, private equity is, well, it's private.
And Coates points out that the name itself, private equity, is actually a bit of a branding trick.
How so? A trick.
Well, when we hear the word private, we naturally think of private property, like a family business.
Right, a mom and pop shop or some founder in a garage.
Exactly. But private equity funds use massive pools of institutional money. Pension funds, university endowments, it's the exact same money that funds public companies.
So they aren't private in the traditional sense of the word.
Not at all. They are just legally structured specifically to avoid the sunlight of the SEC.
So they are taking public money, literally our retirement money, but hiding it in a private locked box.
Correct. They buy whole companies and take them dark.
Take them dark.
They pull them off the public stock market. And unlike the index funds, which are heavily regulated and have to disclose everything they do, PE funds avoid those disclosure rules entirely.
And they lock your money up for a long time, right? I can't just click sell in your Vanguard app and get out.
Right. It's highly illiquid. They usually lock up investors' money for 7 to 12 years.
7 to 12 years.
Yes. And this sector is growing so fast, it's growing faster than the public economy, they are essentially creating a parallel capital universe.
A parallel universe.
The source material notes a crazy statistic. Private equity firms now employ 1 in 9 private sector workers in the U.S.
1 in 9.
Yes.
That is massive. That's a huge chunk of the actual working economy just sitting out there in the dark.
It is huge. And unlike the index funds, which are these big, transparent giants that everyone can see, PE is completely shrouded in mystery.
I'm guessing they want to keep it that way.
Oh, absolutely. They engage in massive regulatory avoidance. They lobby aggressively in Washington to keep their specific tax breaks and their secrecy intact.
This just seems like a really dangerous combination for the economy.
That's a perfect storm.
On one side, you have the index funds, which concentrate all this voting power out in the daylight. And on the other side, you have private equity moving huge chunks of the actual economy into the dark,
Yeah.
where nobody can see what's happening.
And that right there is the full problem of 12. We are
Wow.
living through this massive historical shift in capitalism. We traded the managerialism of the 20th century, where the CEO was king, for a totally new era, where a tiny group of financial institutions holds all the keys.
It's kind of funny. We started this deep dive by talking about how annoying the corporate managers found the SEC back in the 1930s. They called it Russian.
Right.
But now, looking at this concentration of power, we might actually look back on that era of SEC sunlight with a lot of nostalgia.
We really might. And the big question Coates leaves us with is a difficult one to answer.
Because it's a trade-off.
Exactly. Index funds bring massive, undeniable benefits to the average saver. You and I benefit immensely from those 0.06% fees and that super easy diversification.
It's the best thing to happen to retirement account.
But the cost of that financial convenience is the staggering concentration of political and economic power.
And then on the flip side, private equity offers these potentially high returns for pensions, but the cost is total loss of transparency.
Exactly. The last time we had a concentration problem this bad was in the 1930s, and we solved it with the SEC. We forced disclosure.
Well, what is the solution for this specific problem of 12?
That's the hard part. We can't just break them up using antitrust laws without destroying the massive economic value they create for regular people.
Right. If the government swoops in and breaks up Vanguard, fees are going to go up for everyone. The little guy gets hurt.
So we are fundamentally stuck between efficiency and democracy. We can have cheap, efficient investing, or we can have dispersed, democratic power.
But we really can't easily have both.
It seems so. But the alternative, doing absolutely nothing, means we just passively accept that 12 people, who are unelected and largely unaccountable to the public, effectively become the central planners of infecting capitalism.
Here's where it gets really interesting for you to think about. If this trend continues, and index funds end up owning the entire public market, and private equity owns the rest of the private market, do we even have a free market anymore?
That is the big question.
Or do we just have a planned economy that's run by 12 guys in Midtown Manhattan?
That is a very provocative thought to end on, because if 12 people control the capital, do they eventually control the policy? Do they control the politics?
And are we, as the everyday investors, the learners, are we actually okay with giving up our democratic voice in the economy just in exchange for a tiny 0.06% expense ratio?
It's the ultimate trade-off.
It really is a question worth pondering the next time you log in to check your 401k balance, because you're definitely making money, but you might just be selling your vote to do it.
Fascinating way to look at it.
Well, that's it for this deep dive into the problem of 12. Thanks for listening.
Thanks for having me.